So if you can figure out now where you want your money to go during your lifetime and then where you want it to go in your after lifetime, don't lose that race between dying and becoming destitute. Figuring out what is left over, where it's going to go, you can kind of plan for money to be gifted during your lifetime and spent during your lifetime.
I think we already have kind of the sexy marketing title ready to go, is the biggest myth when it comes to taking income from your portfolio.
Right.
I think when you, as we kind of, get back into another episode of Off the Wall, markets never stop moving. We don't either, as I always like to say. And that's never more true when it comes to portfolio income. And we'll kind of talk about what that means overall. But I think right away is a lot of the time people accumulate wealth to one day turn it into an income stream.
Right.
That's basically the primary reason is I'm going to accumulate this wealth to one day when I step away from work, my portfolio becomes my salary.
Right.
And I think when we think about what does that really mean, a lot of people have this huge misconception, if you ask me. Like, they are just totally missing the point. And that's why I think it's that we get into what is the biggest myth.
Right.
And to just flatline it, the biggest myth when it comes to thinking about portfolio income is thinking it's only about income.
Yeah.
It's about your total return of your portfolio. And just to give a quick jargon breakdown, what does that mean, total return? Okay, there's two components of your return. You have your income return, which is most people, it's pretty obvious, pretty well named. Whatever your portfolio kicks off. Boring, but really important. Right. Again, it's your singles and doubles hitters.
Yeah.
What people usually forget to think about consciously, that is, I think they always know it's there, but the price return.
Right.
How much did my investment actually grow? So give a very simple example. You have $1,000. If that $1,000 grew by $100, so your price appreciated $100, you have 10% growth in price. But let's say at that same time, and let's use bigger numbers. Bigger numbers are more fun. So let me back up. Let's say you got $1 million.
Right.
So again, let's say instead your portfolio grows 10% on $1 million. You have $1.1 million in your account. Awesome. Now all of a sudden, you also got to factor in, well, over that course of that year, there's also $40,000 in the boring dividends.
Right.
Interest, income, whatever it is. So you really didn't make $100,000 last year. You made $140. You made 4% from your income, 10% from your price. So your total return was 14. You just add them together.
Right.
We're not doing calculus. You're just doing addition.
So here's the point I want to make about total return. And I was tapping because I just want to go back in time here a little bit. Okay. Pop quiz. Do you know the year that I started in this business?
Ooh, I know the monument start year. I don't know if I know your start year.
1999.
Oh, fun time.
August of 1999. So, and then I went, what's called in the industry, I went live in January of 2000. So I had like 3 months before the wheels started flying off of everything.
I was just saying, that's why I said fun time. It's like you went right before the big tech bubble pop.
Okay. But I remember sitting, okay, so for some history for you and the listeners, when I started out in this business, I got a job working at a firm called Donaldson, Lufkin, Jenrette, DLJ. Like, it was white shoe, Goldman, Lehman, Morgan Stanley. It was one of those white shoe firms. And I hate to say this, don't take it the wrong way, but if that firm still existed, I don't know. I think I'd still be working there. Like, I loved that firm so much. I loved working there. It was bought by then Credit Suisse First Boston, which became Credit Suisse, which is now UBS, and it's a whole mess. But anyway, DLJ. Started DLJ. And I remember the moment the Dow hit 10,000. Like, we each got given a copy of the Wall Street Journal to keep. Wow. Like, I had the Dow 10,000 hat.
I was going to say balloons fell from the sky.
All of it. Okay. So when you talk about total return and the Dow Industrial Average literally at this second at 3:32 p.m. on January 28th, 2006 is trading at 49,000 almost exactly. Okay. I mean, let's do some Dave Armstrong rounding up and say it's 50,000, down 50,000. I mean, when you think about total return and everything that happened between the first time the Dow hit 10,000 and then went down to like 6,000 during 2000, I mean, and now we're at all of that. Like, if you just went to sleep for 30 years and woke up and didn't experience any of that volatility, you talk about total return, like that is total return.
Yeah.
The S&P 500 is going to cross 7,000. Well, it's pretty close. It's at 69.85 right now. So I don't know. When you say total return, I just have this flashback to like where the Dow and the S&P were when I started out in the industry, and here we are in 2006. Like total return's a real thing.
Well, and the Dow didn't grow all that just because there's some dividend paying stocks in it.
Right.
It grew because of the price appreciation.
Yeah.
So back to this whole point that we're talking about is,
I'm sorry, did I get us off track?
no,
Okay.
no, Dave was right there. There's that rabbit hole was very shallow.
Hey, we're not talking about frigates. So that's a huge improvement from one of our previous episodes.
But it is about the long-term nature.
Right.
Is yes, income is great. Don't get me wrong. The income is very useful. But if you're so focused on the income that your portfolio produces, you're missing more than half the picture, in my opinion.
Right.
You're missing the majority of
Well,
it.
because a dollar is fungible. If you need a dollar, it shouldn't matter where it comes from.
Correct.
Interest, dividends, just selling the stock and harvesting the gain. It's just the dollar comes to you and it doesn't have like a mark on it that says where it came from.
No.
So people should really be agnostic about it. Again, you should look at it in terms of total return.
Yeah.
That's the end of the podcast episode. Thank you, everybody, for showing up. So
It's been fun, but I think we got to do a little bit more work on that on this one, because there is, I think, a lot of people make the mistake of looking at a investment's yield and getting suckered into a high yield investment.
Yeah.
They see, oh, this yields 10% or 7%. That's really nice. I should be in that investment. I'm here to tell you, most of the time, the story is probably too good to be true.
Right.
If you're really picking investments based on yield, you're opening yourself up to, I think, a few big risks.
Yeah.
And I don't want to lose the listeners here, but I am going to use some math. Is the math behind how you calculate an investment's yield. It's very simple. The annual amount that you receive divided by the current price. It's a fraction.
That's it.
So there's two ways you can get a high yield. You can have a really big numerator, that top number, so you can be generating a lot of income.
Right.
The more often, though, the way that I see a high yield investment has gotten that high ratio, that fraction,
Is the denominator sinks.
so low.
Right.
And when you're dividing by a small number, that makes the end result big.
Yeah.
So sure, an investment might pay a lot of money, but if that current price is going down and getting smaller,
Right.
it looks like it's a high yield investment, but are you actually making money? Probably, maybe not.
Right.
You know, if it yields 7 to 10%, but the price drops by more than that, say 15, you lost money.
Right.
And most of the time, there's a reason it has a high yield is that the price is going down. It's a riskier investment. I think another way you can look at is a company's dividend payout ratio.
Right.
It's very important. And I think when you look at it, it's looking for a healthy dividend, a healthy company, because dividends are just payments of company's earnings. So a company has to be making money to pay it. So what you can do is you can get the percentage. You can take the percentage of the dividends they're paying over their income. You want that number to be low. You know, you want a company to be reinvesting its earnings, its growth, back to growing the business even more, not necessarily paying it all out. So you don't want that number to be 100.
Right.
Most of the time, though, you see in high yield investments, it's a very high percentage, 80, 90, God forbid, and I've seen it, it's over 100, meaning a company is borrowing money to pay their dividend.
Right.
You're basically robbing Peter to pay Paul, right? You're taking on interest and debt to do that. And again, this is all to support a high yield, and people get suckered into that.
Yeah. It's also interesting because when you think about there's some stocks, and we own them, that we've added to the portfolio back in 2014, 2015 timeframe. And the position, if you know, on the day that we added it to a model, and you look at what the price return is today, it's only up 25%, this holding, but it pays a yield of 10%. So sometimes people look at it and they say like, well, I don't have a really big gain on this on this holding, but it's been stamping out a 10% yield. But then you could also make the argument, you could say like, yeah, but your opportunity cost there
Mm-hmm.
was being in a stock that you would expect to be up. I mean, you just be in the SPY and be up 10% on average,
Year over year. Yep.
right. But you can have an interesting academic and emotional conversation about dividend paying stocks. Like, great, you may feel great that you were getting a 10% yield, but like at what opportunity cost of being in something else? Like, what if instead of getting that, you were in NVIDIA?
Yeah.
Anyway, I'm sorry. I
No,
got
no,
off
no.
track.
But
What
and
you
I
gonna
think
say?
I totally, because I think it is a trade off. Because for some people, they want maybe not as much price appreciation. They want more income,
Yeah,
but you rarely get both.
right.
You got to pick and choose
Mhm.
and what you're comfortable with. And there's different reasons for why you do one or the other.
Right.
But, and I think we say this, or I've heard you say it a few times, is dividend paying stocks are great. But if you're holding a melting ice cube, meaning the price just keeps disappearing,
Right.
what are you really achieving long term? Not a whole lot. It's about that total return. How does
Right.
price and income work together?
Yeah.
And I think when we think about kind of total return, it really is an answer to a key question, and a question everyone asks that we get all the time is, how much money can I take from my portfolio? Getting back to kind of that biggest myth that we kicked off, I mean, that's really the question that is really important.
Yeah.
A lot of people, again, focus strictly on, well, I'll just take the income from the portfolio. Well, if you're doing that, you might be doing yourself a disservice. You might actually be able to take more from a portfolio to figure out and spend it because you're using some of that price return.
Right.
Not a bad thing. But I think the question that you should be asking isn't how much money can I take, is what is a sustainable withdrawal rate from my portfolio? Meaning, what percentage of my portfolio can I take in any given year without depleting its long-term growth and preserving kind of, the corpus or the principal that you've
Right.
invested?
And I'll even take that a step further and say that sometimes that calculation and that decision matrix is what is a withdrawal rate that I can have that is sustainable enough even though I'm depleting my principal,
Sure.
right? So like if you're in your late 80s and your sustainable withdrawal rate, you may not care how much money you have relative to somebody who's 35 years old,
Yeah. It's
right?
more
So
about not running out of money.
that's right. Or losing the race between dying and becoming destitute, right? That's the race that everybody wants to win slash doesn't want to lose, right?
Yeah.
And that factors into sustainable draw rate because there's this emotional component too, where people say, I just don't want to run out of money. I don't want to lose the race between dying and becoming destitute. Nobody wants that. So how do you figure that out? Well, it's not just a number. It's not just
Sure.
a percent. It's like you have to model it.
Yeah.
It's a little bit more complicated than just saying, hey, I'm going to take 4% of my portfolio out a year because that's what I read in Money
I was
Magazine.
going to say, where we
Right,
get your 4%, David.
right, yeah,
It's the
exactly.
rule of thumb.
It's the rule of thumb. Well, great. It's the rule of thumb per asterisk.
Yeah.
Like, what else is going on? Like, if you're 85 years old, you probably do more than 4%. If you're 35 years old, maybe you shouldn't be taking anything out. So,
It's so dependent. And honestly, I hate the 4% rule of thumb. I always find it to be too conservative. And I think, again, I get it. We got to model everything. If you want to close your eyes and pick a number, I like 6%. And the reason being is when you look at long-term returns of a blended stock bond portfolio,
Mhm.
stocks over the long term, 9 to 11%. Bonds, 3 to 4. So if you take a portfolio that's, let's say, 70% stocks, 30% bonds, your expected return is over 7%, 7.2. So if you took 6% a year, you still have a little bit of growth left over.
Yeah.
But you are really depleting the long-term growth of your account. Like, it's only growing 1.2% on a net basis
Mhm.
after you factor in those kind of withdrawals. So I get uncomfortable when I hear people saying, I'm going to take 6% out or more.
Right.
That's kind of my line in the sand. Where it's like, okay, let's do a lot more work. If a client comes to me and say, I want to take 2, 3, 4%, most of the time I'm not too
Yeah.
worried.
I'm going to get off on a little bit of a tangent here and say that there's another component to this sustainable withdrawal, which I will call sustainable gifting.
Sure.
Right. So people who are older and they have a great nest egg of money and they look at it and they're in their 80s,
Mhm.
right? And they have kids and grandkids. And they say, okay, how much money can I gift out of this portfolio, parens spend out of the portfolio,
Yeah.
right? Remove from the
Distribute.
portfolio, right? Without jeopardizing the outcome of the race between dying and becoming destitute, but see my family that I gift the money to enjoy it while I'm alive, because chances are a component of that money is going to go to them when they've passed away, and they don't get the enjoyment out of seeing what the kids or the grandkids
Yeah.
do with that gift. And I didn't make this term up, but I've been using it more, which is, do you want to give with a warm hand or a cold hand? Because either way, that money. So part of that sustainable spending could also be interpreted as, what is your sustainable giving plan?
Yeah. And there's a lot of value in that too with, again, we're not a financial planning podcast. We're going to stick to investments, but estate planning that
Yeah.
can help a lot with.
Right, right. Here's a way to think about it. If you're listening to this and you're thinking about sustainable withdrawal rate, sustainable giving rate, is this: money can only go one of four places in your life. You can spend it during your lifetime, and then after you, or sometimes you'll hear this referred to as second to die of a couple, it can only go three other places. It can go to friends and family, which you designate through a trust and estate plan. It can go to charity, which is also designated through a trust and estate plan. And in certain cases, some of it will go to taxes, although that's
Hopefully avoidable.
right. So that's it. So if you can figure out now where you want your money to go during your lifetime and then where you want it to go in your afterlife time, don't lose that race between dying and becoming destitute. Figuring out what is left over, where it's going to go, you can kind of plan for money to be gifted during your lifetime and spent during your lifetime.
Yeah.
So
And so many people, again, limit themselves to just the income the portfolio generates. And I don't get it.
yeah,
I don't understand why it is sometimes. I don't know if they feel like they're eating into the growth, which they are, but I mean, that's what the money's there for.
yeah, right,
Just don't eat
Mhm.
into all of it.
Right.
You know, have a salad, don't eat the whole steak. I don't know an analogy we can make up there, but really what you want is a portfolio that'll last and support you.
right.
That's all this is. And when you, and don't shortchange yourself.
Right.
guys.
Well, here's another way to say it. Like, your portfolio statement that you get in the mail every year, every month, shouldn't be looked at as a piece of art that you look at and appreciate and hang on your
Yeah.
wall. Right. Your portfolio is not a piece of art that is meant to be there to be appreciated and hang on your wall. It's there to provide utility.
Correct.
And if you can figure out what utility that portfolio is serving, you can probably make some better decisions so that the utility is seen during your lifetime.
Yeah.
I didn't mean to turn this into like a trust estate conversation, but
No.
it goes into the sustainable giving
It
and
does.
spending, right? So, yeah, I think there's that component to it as well. So it's not just like the rule of thumb doesn't account for any of those things I just talked about.
Yeah. I think that's when you're constructing portfolio specifically, it's got to be for you.
Right.
It's not for anyone else.
Mm.
I mean, yes, sure, family, blah, 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 blah. We can get into all that. But really what it is how does it work for your situation? So we talked about, I said the 6% rule. If you need to withdraw more than that, but that's what it takes for your retirement, for your lifestyle you want to live, I'm not going to say no, but we're going to model it out and we're going to talk about costs and benefits.
Right.
And that's all this really is are you actually costing yourself money by only relying on the income and just completely, for whatever reason, not thinking about the price return and your total return by extension? And really, again, I almost hate to see clients when they go, I need to start withdrawals from my portfolio. And they go, okay, but like, I don't want to tap into price return. I'm like, okay, well, that's not possible.
Right.
Some people can live off lower distributions or lower percentage, but realistically, you're going to have to. So build a portfolio that can do that.
Yeah.
Right. And it's not by picking necessarily the top performing. I mean, you mentioned NVIDIA. NVIDIA, I don't think pays a dividend. I could be wrong there, but a lot of those large cap growth names don't pay dividends.
And NVIDIA is so 2025.
Who knows? What's this here? Gold? I'm not opening that.
Come on.
We talk enough about gold, but it at the end of the day, all that matters is that it works for you.
Right.
So don't boat race yourself against other people.
Mm-hmm.
If you hear your friend has this investment that's yielding 10 to 15%, what we just talked about, maybe they're in one of those pitfalls of high yield.
Right.
And you have other people on there who are like, well, my portfolio only generates 4%, or 3%, I can only live off that. Well, they're probably missing out on experiences that they can easily afford.
Right.
Just by making sure that you have a portfolio set up for total return.
Right. And rules of thumb, I mean, they're okay. Like, okay, if you ask me, hey, how long does it take to drive to Richmond, Virginia? hour 45 minutes. Right? Okay.
What about traffic?
Well, right. It doesn't take into account traffic. It doesn't take into account the fact that I may want to stop off at Chick-fil-A on the way down, whatever. So, but if I know that it takes me an hour and 45 minutes to get there, so I leave giving myself 2 hours to get there. And then rather than driving the speed limit, I'm driving 90 miles an hour to get down there.
Yep.
All I did was increase my chance of getting a ticket, increase my chance of getting into an accident, or both. All for what? Getting there 30 minutes before I plan to be there, and I'm sitting around waiting for the meeting to start. So, like, the rule of thumb is fine for planning, but, like, don't increase the chance of a risky event or anything like that just to drive faster down the highway. So I came up with that about that.
Yeah, yeah, and maybe now we have two myths we just uncovered because I think you're nailing it there. The 4% rule, kind of a myth.
I mean, it's like, okay, if I drive 60 miles an hour, how far am I going to go in an hour? Fine. Okay, you can until you hit traffic on 95.
Correct.
Right? And you didn't get into the hot lane.
Oh man, don't get me started on that.
I will not get any. I am always in the hot lanes. I just won't do it anymore.
No. It's not worth it. Again, back to our point. Right. Again, it's just frustrating. And that's why I think I wanted to have this episode and I kind of push forward is I don't like seeing people leave not just money on the table.
Mm-hmm.
That's painful enough. It's leaving happiness and experience.
Right.
I mean, your portfolio, as much as we love to talk about numbers, emotionless, that's how you make decisions.
Right.
But really what it's there is to support those. So, all right, soapbox off. I don't need to talk anymore about that.
Oh, right. Exactly. All right. Well, look, if you've made it this far in the episode, we appreciate you making it this far. If you did, boy, you really put up with some sex.
A lot more than just investments today.
First of all, that's what makes it fun sitting in the chair and doing this podcast with you, Nate. So is when we get off on little tangents like that. But if you made it to the episode, thanks for listening. I want to remind you that we do have episodes in addition to things like this.
Mm-hmm.
Off the Wall's got our Ask Monument Anything or AMA, which is kind of a play on Ask Me Anything, but whatever. Okay, we answer questions that people ask us. Here's how people ask us questions. They say some sort of comment on YouTube, or they put some sort of comment into social media or LinkedIn when we post their videos. But we also have an email box that you can use. Just shoot us a question there. We get it. The address there is offthewall@monumentwm.com. So all one word, right? offthewall@monumentwm.com. Shoot us an email. We get it. We'll get the question. We'll load it up into our monthly AMAs and we'll answer the question. And so whatever. And sometimes we get questions just from clients that call in. Sometimes we get questions from just whatever. And we answer those too. So we share the answers to the questions we're getting asked off camera.
Yeah, I got a question from my barber the other day who is asking just kind of about it. And so that'll get thrown right into the AMA queue.
Pay your barber to cut your hair? Or?
I do. Oh. I used to cut it myself, and I know this is a complex cut, but hey, I let people go.
You look like you just came off a drill weekend.
And I'm paid. Simple, easy. I was never in the military, but I do have some tendencies about that.
Oh, it's pretty good.
And I think again, we just really try and answer current market topics. Like as I said at the jump there, markets never stop moving. We're not going to stop moving either. We love those episodes because we get to talk about what's going on.
Right.
So, well, thank you everyone. Another great episode. Yeah. We'll see you next time.
The content presented by Monument Capital Management LLC is intended for general informational and educational purposes only. No portion of this content should be construed as the receipt of or a substitute for personalized investment, financial, legal, or tax advice. Monument is neither a law firm nor an accounting firm, and no content should be interpreted as legal or accounting advice. Any discussions of investment strategies, financial planning concepts, or related topics are general in nature and may not be appropriate for every individual or situation. Different types of investments involve varying degrees of risk, and there can be no assurance that any investment strategy, planning approach, or discussion referenced will be profitable, suitable, or successful for any particular person or circumstance. Past performance is not indicative of future results. From time to time, this content may reference hypothetical situations, illustrative examples, or stories that do not involve actual Monument clients. These scenarios are designed solely to illustrate concepts or demonstrate how Monument might approach similar situations and should not be interpreted as endorsements, testimonials, or guarantees of any particular outcome. No two clients, situations, or experiences are exactly alike, and results will vary. Nothing discussed should be interpreted as a guarantee that any client or prospective client will experience a specific level of results or satisfaction if Monument is engaged or continues to be engaged to provide investment advisory services. Monument's investment advisor registration status or any prior experience should not be construed as an assurance of future performance or success. Copies of Monument's current Form ADV Part 2A, Disclosure Brochure, and Form CRS, which discuss our advisory services and fees, are available upon request or at www.monumentwealthmanagement.com/disclosures.